with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based in Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, September 5th, 2025. Shortened week this week as we had Labor Day weekend. Hope you had a great one. I want to start with a big shout out to those listening around the world. Taking a look at our podcast stats. We got a big following in Canada, Australia, United Kingdom, Kuwait, all of our military over there. Spain, Mexico, China, Switzerland, even Barbados getting in on the action, and some small ones, Belgium, Singapore, etc. So hey, thank you all for tuning in. And look, I got to give a big, super duper shout out to all the folks in Delaware who voted us as the number one financial planning investment firm there with the Delaware State News, the Stars of Delaware. Some members of our team had the opportunity to go out to their event at King Cole Farm. What a lovely venue. I've been there before. Great if you want to do a wedding, corporate event, whatever. Beautiful place. It just means a lot to us that our clients are so supportive. I mean, we're in the running with national firms, Merrill Lynch, Edward Jones, these big national firms. And for us to come out on top year in and year out just means the world to us. So thank you, Delaware. Hey, and look, for the rest of you, all you folks out there in Canada and Australia, Spain and whatnot, Barbados, what gives, huh? We've not won anything there. Help us out here, will you? I'm kidding. All right. Hey, let's jump into the numbers. Talk about what's going on this week. Markets, they kind of sloppy all over the place. They finished mostly on the positive. The Dow Jones was down about 0.3 this week. The S&P 500 up 0.3. The NASDAQ actually showing some strength there, up 1.1% this week. And the Russell Small Cap Index up 1% this week. Looking at some other data points, the Volatility Index down 1.1%, coming in at a 15.1, so still at a relatively complacent level there. The long-term bonds as measured by the TLT finally getting some traction, up 2.2% this week. Almost all of it happened today on Friday. I will tell you why in a moment. It was up 1.6% today. Up 2.2% on the week, and just turned positive on the year here in September. Long-term bonds now up 1.4% on the year. They have been struggling in a mighty way. And then we dig deeper and look into the different sectors of the market and what did what this week. You had utilities were down about 1%, energy down big, down 3.3%. OPEC had some news. They're pushing their production levels higher. Energy is not responding well. As a matter of fact, I was looking at some technicals on energy with one of the firms that we do a lot of work with. And when energy has done what it's done in the last couple of weeks, it usually hasn't performed very well over the next 6 to 12 months. So we're going to be taking a hard look at our energy exposure here, moving into the beginning of next week, maybe making some changes there. But energy down 3.3% this week. Financials down 1.7%, not doing a whole lot this week. Most of that happened today here on Friday. Everything else was kind of flat to up a little bit. Communication services, that was up a lot, 2.9%. You can thank Google for that. They actually won an antitrust lawsuit, and therefore the stock spiked in a major way. But then here on Friday, they are being fined again by Europe for antitrust measures, and Trump administration is talking about taking some retaliatory actions. We'll see what happens there. And what about the metals? Good gravy, man. Gold up 4% and silver up 2.8% for the week. So moving strong. Of course, we got Kinross Gold. I've been talking about that. It was up 5.8% on the week. It's up 138% on the year. Look, I got to tell you, it's looking so stretched. This gold trade it's getting up to the stratosphere here where the oxygen's starting to get really thin. So you might be seeing some changes there moving forward. As a matter of fact, you might be seeing quite a few changes on some things here moving forward because, well, let's talk about the news and I'll tell you why. A couple of things. First of all, getting started this week, markets got knocked around a little bit because some federal court claimed that the Trump tariffs were illegal. And that caused a little bit of chaos in the market. I mentioned that to you, way back in the spring. I said, I'm not really sure how this could be legal. If one man can just put 100% tariffs on another country, he could just do that to everybody and just shut down the whole world. It seems like a little bit of a stretch to me to have that much power, but I'm not a law scholar. I'm just trying to make you money. So anyway, the court did say that it's illegal. Now, what's interesting is what I find kind of funny here is the market hated all the tariffs earlier in the year, had this big conniption fit, and now you got over $300 billion coming into U.S. Treasury, kind of helping to pay our bills to some extent, and the economy and the markets have held up relatively well in spite of all that. Now the market doesn't want to give it up, right? It's like, hey, wait a minute, this is kind of working. We'd hate to see that all go away. So I'm sure they're going to fast track this to the Supreme Court. It'll be interesting to see how it shakes out. I find it unfortunate on one hand. I think Trump has done a pretty good job getting to where he is today as far as the tariffs are concerned. And to see all that kind of blown up would be unfortunate. But at the same time, I'm not sure if Congress needs to be involved or what have you. They're the ones that are supposed to hold the purse string. So going to be interesting moving forward. Earnings really haven't been a big deal. A couple little things here and there. But economic data, I've been watching that pretty close. Some of that's been a little bit sloppy, but the big number of the week came today on Friday, and that was the August non-farm payrolls report. It was a lousy number, 22,000 jobs. Now, I mentioned last week, if it was a lousy number, the market would probably rip higher. Well, it started out that way. Opened up this morning, hitting a record high, just coming out of the gate, shooting sky high. But I think that the concerns about the economy, look, we had some revisions to put June at a negative. June actually lost jobs, negative job growth in June, and only 22,000 for August. Out of a country of 350 million people, 22,000 jobs is anemic at best. So markets seem to start to maybe get a little bit more concerned, and bad news actually became bad news by midday. The market started to roll over and go down, except for small cap stocks. They continue to stay very strong, up 0.5% on the day because small caps are going to benefit the most from rate cuts. And that's what the market's sniffing out there. You also saw other pockets of the market do well today. Home builders did very well today. Things like Rocket Mortgage had a really big day, up 6% on the day, Rocket Mortgage. So you saw stocks that are going to do well with rate cuts perform well on the day. But the overall major indices, Dow, NASDAQ, and S&P down on the day, but the small cap index holding up because they do stand to benefit pretty well from rate cuts. So what does all this mean? What's the Fed going to do? How's the market going to respond? A lot of questions out there. A couple of things. One, we got some big data points next week. We've got consumer price index. We've got producer price index. These are big inflation numbers. And if they are hot, the market's going to probably flip out a little bit about that. Because look, if they're hot, we could be entering into a period of stagflation. That is not a very nice place to be. That's when you have low growth with higher inflation. Now, the growth has been okay as far as GDP is concerned. The economy is showing good GDP numbers, but if these labor numbers are any indication, then some things could be softening here and there. So we'll be watching those numbers really close. The market could react to those next week. And then all eyes will be on the Fed on September 17th. Look, this market is probably shaping up to buy the rumor, sell the news type of event. In other words, if it keeps pushing higher here as we approach it September 17th, and Fed Chair Jay Powell does not say what the market wants to hear in full, because the market wants to hear, folks, I'll tell you right now, it wants to hear a minimum of 3 cuts. That's what the market wants. A quarter point is laughable to the market. That's not what it's looking for. It's looking for at least 3 rate cuts, about 0.75%. Is what it's looking for. And if it doesn't feel confident that that's where we're headed over the next few months, then you could see a pretty negative reaction, which would also line up seasonally. The last 2 weeks of September tend to be pretty lousy. The first few days of September tend to be pretty good right around the holidays. So we'll watch all of that. Look, a couple of other things I'm going to point out. If you've got a mortgage, if you have a mortgage that you just took out in the last 2-3 years, you're up in that 7% range, keep your eyes peeled. We're moving down towards 5% here pretty quickly, down to 6.2% on 30-year mortgages today. So an opportunity may be coming for you to refinance in the coming months. So keep an eye on that. If a recession comes about, then you can really have a great opportunity to refinance. And look, we've been saying since the beginning of the year that our outlook is that there's a higher risk for recession in 2026. Just looking at the cyclical nature of it, that's something to be concerned about. Look, when you look at history, going back prior to the Great Depression, you go back to 1855, move your way up to 1940, we had about 3 or 4 recessions every decade, like one every couple of years, substantial ones at that. Now, from the Great Depression on, once we started to monkey around with trying to manage the economy, print money, all that sort of stuff, it's been a little bit different. We've been averaging about 2 per decade. And look, the last one we had was 2020. I do think that we're on borrowed time. How about that? I don't think that it's imminent, but I think that we, anyway, here at BIG, we're going to just stay buffered for the unexpected moving forward. All the easy money from 2022 today has been made. 2022 is a terrible year. The easy money's been made. Moving forward, this risk is going to stay in front of us. And I've been watching different things, looking at the Fed recession, the smooth recession probabilities. It's been inching higher. These numbers, these job numbers, they don't look that great. There's definitely some concerns here and there. On top of that, I saw a report this week that was a little bit alarming in regards to the stock market valuation. When you take all of the different valuation metrics, PE, the Cape-Shiller, all these different types of metrics that are out there to value the market, it is at the highest point that it has ever been on some metrics, even higher than it was before the tech crash back in 2000. The market can certainly go much higher. Don't get me wrong, that can change, earnings can continue to rise, et cetera. What I'm trying to point out here is that we want to take a very measured and disciplined approach moving forward because I don't fully trust what the future holds. I do believe this market goes higher going into 2026. It can go lower over the next couple of weeks, but it definitely is pointing higher to me going into 2026. But moving through next year, you just don't know. And there's a lot of little things creeping up here and there that have my attention. So that's how we're going to be managing money moving forward, is just being more disciplined. If it means we make a little bit less money, I'm okay with that. I would rather make a little less and be prepared for the unexpected at this stage of the business cycle than to be swinging for the fences and get burned, because you depend on us to manage your life savings, and we take that very seriously. So look, I'm going to wrap up, but between now and next we meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe it's travel to Canada, Australia, UK, Kuwait, Spain, Mexico, China, Switzerland, Barbados, or Belgium, Singapore, Bahrain, Pakistan, India, and Germany. Thanks to all the listeners out there. Hey, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.